The way to be in the market to go up SPX 26, 27% last year was to read Dutta. He joins us this morning. Has your optimism weakened, Neil?
No, I mean, we have to focus back on the fundamentals, and ultimately healthy fundamentals can help turn the market. For all the talk about how this is a Fed-driven slowdown, I mean, where's the flight to safety in the dollar? Why is emerging markets outperforming this year? I mean, it's a very sort of interesting period for the financial markets. But, on this sort of idea that growth is decelerating, like so many things, I mean, potential sightings, like UFOs, potential sightings, not actually confirmed. I mean, you think about housing, the housing market's accelerating. There's a lot of construction activity in the pipeline. I would expect motor vehicle production to also be accelerating this year. That's substantially running below trend. And oh, by the way, we have, two of Asia's largest economies taking steps to support growth this year. So I think, and with the Omicron variant beginning to fade, I mean, that's going to provide a positive demand shock to the service sector. Not only in the U.S., but globally.
Okay, this is really critical and goes to Krugman's essay this weekend, which I thought was brilliant, partitioning the demand side dynamics with the supply side dynamics. And what you're suggesting, Neil, is within the gloom, demand will remain resilient?
I believe so. I mean, take a look at mortgage purchase applications, Tom. I mean, even though interest rates have been backing up, purchase applications have actually been strengthening during that time, which tells you that maybe it's not only about interest rates, but things like price expectations, right? So the user costs for housing, even though rates have gone up, remain low because price expectations also remain firm, right? So people are going to be much more willing to finance an asset they think is going to go up in value, and that's underpinning demand in the housing market. I mean, you're at a situation now where the builders are actually throttling sales again. So, this isn't a demand issue. Look, I mean, this deceleration call, yes, growth will decelerate. I mean, that doesn't take a rocket scientist to figure out. I mean, we're growing very rapidly off the lows in the pandemic. And believe it or not, a deceleration is priced in. I'm looking at ECFC and Bloomberg right now. Quarterly growth expected to grow from 6% in the fourth quarter of this year down to 2.5% in the fourth quarter of 2022. So it's about what's priced into the market and consensus expectations and what's the likely outcome relative to those expectations. And my sense is the inflationary boom is largely continuing this year.
Okay, so if the inflationary boom is largely continuing, then how about the risk that people were worried about maybe a week ago about the Fed hiking rates too quickly? Do you think that that's an overreaction as well, since the Fed's going to act cautiously and move slowly so that they don't disrupt anything?
Well, I think the market is right to price in hikes this year, but I mean, I think we're getting a little bit over our skis. I mean, it looks like the Eurodollar futures market's basically priced for a coin flip for a 50 basis point move in March. I mean, if history is any guide, recent history, so basically since from the 90s on, the Fed's more likely to end a tightening cycle with 50 basis points than start one with 50. So I think the odds of them going 50 in March is basically zero. But as I said, I mean, 4 hikes and runoff this year, I think that's a reasonable baseline. But I think where the market's getting a little bit over its skis here is, pricing in 5 hikes, maybe 6 hikes potentially. Those hikes probably shift more into 2023. So the market's right to price in a little bit more of an aggressive Fed. But let's be honest about this. Is the Fed really hawkish? I mean, other central banks are already hiking, Lisa. And maybe that's one of the reasons why, even though the kitchen sink has been thrown at the foreign exchange market, the dollar has actually been flattening out over the last 3 months.
There are 2 concerns here right now, right? There's the inflation side, which you actually endorse. You think that inflation is going to be stickier this year throughout the year. And how much does that crimp consumer demand, which you think it won't necessarily do? And then there's the idea of the Fed responding to this, which will at least shake risk markets, which possibly is the reason why you've seen such a huge drawdown, particularly in the NASDAQ. On the first point, how much can you dismiss some of the retail sales data that we got out, some of the peripheral sentiment data that suggests that consumers really are paring back on what they're buying because their purchasing power has gone down so much?
So to me, if you look just at average hourly earnings, that gives you an incomplete picture of just how strong the consumer is, because you have to look at aggregate wages and salaries. That's the sum product of jobs, the work week, and hourly earnings. And that's running at a very healthy rate. In fact, it's running double digits. That was true in December as well. It's running well above the pace of inflation. So the aggregate sort of real income pie is growing. At the same time, we haven't even actually had a household credit cycle yet. If you look at consumer credit, revolving credit relative to things like disposable income or core consumer spending, it remains well below normal. So households haven't even taken on normal levels of credit appetite. So there's room for improvement there. But we really going to worry about consumer spending when people are putting on down payments for homes? I mean, you're worried about whether they're going to be buying cashmere sweaters during the winter when they're buying houses. So I think,
Right.
and that's durable goods. Those are durable goods, right? So, and that obviously has tentacles into other areas of consumer spending.
Neil, you delay the Fed rate moves into 2023. Doug Cash just published that he's buying at the sound of cannons. This off of Nathan Mayer Rothschild from years and years ago. You step up to the sound of cannons and start buying into the market. The underpinning of that is framing the Fed call. Let's be clear here. How many rate rises do you see in 2022? Are you in the camp with Stephen Englander at Standard Chartered that we're going to see a lot less movement by the Fed than expected?
Well, I think there's a decent amount of dispersion with the Fed, but
yes.
Look, when Minneapolis Fed President Neil Kashkari is telling you that he's penciling in 2 rate hikes for this year, I think that's a reasonable baseline of how much the Fed will do, at least at a bare minimum this year. And it's probably, something where they go in March and June at a minimum. Then they'll do runoff. And then if inflation is sticky, I think you can pencil in hikes in September and December. The Wall Street Journal was out today talking about how the Fed may go at every meeting. Again, it just tells you about how much hawkishness is already priced into the markets and how little the Fed actually has to do to surprise in a dovish direction. So I think that you'll probably see a bull steepening of the yield curve going in or immediately following the meeting. That's what we're telling our clients. I think the front end has room to rally here.
The front end has room to rally. So in other words, you're telling your clients to buy short-dated bonds and buy the risk story. Is that the idea?
Yeah, for a trade, Lisa. I mean, coin flip for 50 basis points in March, the odds are 0